Good evening, ladies and gentlemen. Happy Saturday to you all. Hope you're having a wonderful start to your weekend. And if not, let's see if we can change that for you guys. So as the title indicates, never before in history. Well, I like to say never before in history have we had a yield curve inversion like this. As you guys covered in the previous weekend's deep dive, this was not expected. The yield curve trying to point back up, re-inverting, that was not expected. Never in history has this basically happened before. Now, the one caveat is this could be a very big, wide range for the up and down that I was talking about last weekend. However, we're very close to breaking the localized high and this basically thing ripping right back up. And we're going to be talking about some of the things that could actually cause that to happen, which will be the first time in history that this would happen. It basically spelling 1929 hold my beer moment for the market, and it would be a bumpy ride. However, there's people saying that the S&P and how it's trading is going to go to new all-time highs, and we had a pretty massive rip in the markets, as you can see here, into Powell, push past Powell, and just kept going during the week. We did have a cut on Thursday going into Friday. However, we'll cover why that happened in the debate section, in the key level section, but I'm just giving you a brief overview here, and then we'll go over the heat map along with the next trading levels for the following week that are important for us. A couple things to note: that RSP actually did not make a new higher high on the week. So again, kind of beating this at dead horse here that RSP is range bound right now. You're not having a broader market rally. If we just quickly jump over the heat map, as you can see here, the bigger blocks are green while broader market is still red. It is not like, let's say, the 3-month where, well, that's pretty bloody as well. Again, this emphasizes that 3-month trend of broader market selling off, and that's why the IWM and the RSP, jumping over to IWM, Russell even worse. So small caps are basically being punished. S&P is being pushed up by few companies, aka the big six. And is it going to continue? Well, let's recap what happened during the week so we can talk about where this thing could be actually going. Some notable events: trade and balance still stayed larger negative, but that's really not important. We had a couple Fed members speaking. Monday was kind of meh with employment trends staying exactly where we expected it. However, what was surprising is the API weekly crude oil stock. They were expecting a drawdown of 0.3 million. They got 11 million build, which was massive. Oil basically tanked from it. However, if we jump over to oil real quick, real here, as you can see, absolutely tanked below all the moving averages. So I was wrong about oil. I was saying when we were back here that I liked the bounces on these trend lines. However, once it broke that trend line completely, yeah, it was pretty bearish, and it just kept getting more and more bearish, kind of forming that head and shoulders pattern right there. But we'll talk about that in the key level section of the video. But I just wanted to recap. And as always, guys, everything will be timestamped down below. So if you guys want to skip any part of the video, feel free to do that. And we thank you so much for watching. If you guys would not mind hitting the like button, it really helps the YouTube algorithm. And if you find value from this, consider subscribing to the channel and making sure bell notifications are enabled. But enough of that. As we can see here, on Wednesday, we had the man himself, Powell. He did not comment on monetary policy on Wednesday, so we basically got a wet willy moment there where we really didn't see anything. Atlanta Fed GDP now, 2.1, expected 2.1. More Fed governors speaking, but again, we're all looking for Powell. Powell's the one that drives market. However, on Thursday, we did basically get some commentary from him. However, what was most notable, the 4 and 8 week bill auctions basically barely got any bids. So once those auctions basically got no bids, little to none, not a lot of people taking the government debt at the rates that they were being offered, everyone was like, nah, we don't want any of this. So that really drove markets steadily down, where the question was, is government debt sound now, where there was a lot more selling than buying? And this probably led to what I just mentioned about the yield curve basically wanting to invert itself right back up again, spelling more doom and gloom for the longer term. As we can see here on Friday, we had Bostic and Logan speaking, nothing really moving there. And then Michigan 5-year and 1-year Fed inflation expectations going up again. The consumers are basically getting sick and tired of inflation, and they don't feel that it's basically going down. Net speculative position staying around the blank. They actually didn't publish anything for the week. So if we jump over here, we can see that they didn't publish anything for this week. Again, very noteworthy about that, where it's when they start losing, let's say, they stop publishing that they're losing. It brings me back into the March days. However, first off, guys, Fatal's going to give you the biggest winners and losers, and I'm basically going to come back for the key level section, and we'll wrap up with the debate at the end, which got a lot of topics to talk about, especially that famous CPI report that's coming out this week. So I'll see you guys in a little bit, and he's going to take it away now.
Last week I said that I believe that the market will continue to go up, in fact make 52-week highs by the end of the year. And as you guys can see right here on the 5-day, well, I think I'm proven right, because the S&P 500 index just gained 1.11% on the 5-day, and on the 1-day, just on Friday alone, this thing is almost a perfectly straight line going upwards, gaining 1.56%. This past week's earnings weren't really that exciting. On Monday, we had companies like Berkshire Hathaway and Realty Income, which we did live stream for. On Tuesday, we had Uber, Celsius, Rivian, Devon Energy, and Occidental Petroleum. Wednesday, Roblox, AMC, Disney, and Warner Bros. Discovery. Thursday, we didn't really have much of anything, all except for, I believe, like Yeti and maybe Himax. And on Friday, we had Algonquin. And next week's earnings for November 13th, we can see that there's a lot of stuff here. Starting off with, well, Monday, we got Starbucks and Rumble. I'm actually really tempted to do an analysis on Rumble. Not so much on a fundamental perspective because we don't have enough data for it, but at least from a technical analysis perspective. On the Tuesday, we got the big one in the form of Home Depot. That's going to tell us a lot, guys, on what in the world the housing market is actually like, or at least not necessarily the housing market, but housing consumerism, right? Are people actually spending money when it comes to upgrading their houses, or is the economy really that bad that, well, Home Depot is struggling? Wednesday, we got Target, we got Advanced Auto Parts, JD, Zim, and Cisco. So those are the few ones that I'm interested in on Wednesday. On Thursday, we got Alibaba, Applied Materials, Walmart. That one's going to be a massive one as well. And then on Friday, we got BJ's. Prepare to see a live stream most likely on Wednesday, Thursday, and Tuesday. So let's take a look at now the heat map, and well, even though the market did gain on the week, guys, we can see that there's still a lot of red here to be seen, mainly in the energy sector, the real estate sector, and even the utilities a little bit. That's kind of surprising. So with that said, let's jump now into the technology sector, and we can see here that the worst performer was the company First Solar, losing 11.86%, and the best performer was none other than Gen Digital, gaining 9.36%. The communication sector, very, very green. However, a few companies here were massively in the red in the entertainment sector as well as the telecoms. But worst performer was Warner Bros. Discovery, losing almost 14%, as well as we can see over here Paramount losing 12.06%, and best performer Take-Two Interactive Softwares gaining 6.46%. The consumer defensives is definitely on the target when it comes to next week because of mainly Walmart as well as Target. However, worst performer here was Brown-Forman Corp, losing 4.25%, and as well as SJM losing 4.17%. Guys, SJM is almost about to be sub $100. Might be one that we may want to buy at this point. This is definitely below my average share price, so I may want to buy some of this some more. And the best performer was none other than the company Clorox, gaining 6.3%. The healthcare sector is very, very overall red, if you guys can see. Very massive green ones, but definitely the red ones overtook it. Worst performer was the company Illumina, losing 15.87%, and the best performer was none other than the company Molina Healthcare, gaining 6.12%. The financial sector is doing all right, I guess you could say. However, the big red ones here are definitely in the regional banks as well as the asset management ones. Now, overall though, worst performer, it's none other than the company CMA, losing 6.19%, and the best performer, it is none other than the company CME Group, gaining 4.07%. The consumer cyclicals are definitely interesting, kind of 50-50, as you guys can clearly see right over here. Worst performer, it is none other than the company General Motors, losing 9.81%, as well as Ford losing 6.63%, even Hasbro losing 8.16%. Best performer was none other than the company Bookings Holdings, gaining 7.54%. The industrial sector is kind of mid, as you guys can see over here. Worst performer, it is Emerson Electric, losing almost 6%, and the best performer, it is none other than TDG, gaining 12.52%. The REITs are crashing once more, as we can clearly see right over here. Worst performer was none other than the company BXP, losing a whopping 11%, and the best performer was the company Extra Space Storage, gaining 11.35%. 1.9%. And the utilities, a few weeks ago, they were up in the green and now they're back down in the red. Worst performer was none other than NEE, losing 7.14%, and the best performer being CEG, gaining 4.01%. And the energy sector is back to being an absolute ruby. Wow, this is interesting. Okay, nothing here gained at all. Worst performer was the company EQT Corp, losing 12.5%, and the overall best performer, at least the one that lost the least, was none other than Baker Hughes, only losing 2.42%. And lastly, the basic materials, overall 50-50, with a handful falling massively. Worst performer, it is none other than Corteva Inc., losing 13.3%, but also, guys, Newmont losing 12.35%. Best performer was none other than the company Martin Marietta Materials, gaining 2.48%. All in all, though, markets, they're getting picked up a lot, mainly by tech. So yeah, the markets are rising just because of one sector once again, which I guess is a good thing and a bad thing. There still is a little bit of, actually a lot of decent value when it comes to the other companies, especially some that have fallen from a massive amount, like for example, APD and even SJM. Might take a look at those in the future, but that pretty much does it for this segment. Take it away, Mike.
So guys, for the key level section of the video, we can see here that we're basically above on the S&P. We're above the trend line, above the 50, above the trend line. So basically we're on a bullish run. There's no denying that for the S&P. However, is it going to continue? Well, let's take a look at some other things out there. We're approaching an area where we had previous resistance on. So this is basically the secondary peak before we had our big drop. So again, we've made higher highs and now we need to identify if we're going to make higher lows. We haven't necessarily made a higher low. I do not consider this as a low. We need to really come down to basically about here to the 430s, or maybe retest the 50-day moving average to be a true lower low and then be expansionary tory from there. So as we can see here, the bullish points that we're going to establish for the week, we have a more range bound possible week where we closed at the high of the week, so our risk to reward is skewed to the upside. So we're expecting at the 440.16 or 93 is where we're basically going to bust out and continue this uptrend. What I would like to see is maybe a gap down, pump up on Monday. That's just my theoretical what I like to see. Doesn't necessarily mean it has to happen. Same way, because we're so close to the 50 down here, if we break the 433.40 area, bounce off the 50, come back above it, close above it, hey, we're going to get a nice rotation to the upside. So we definitely have to look more bullish skewed right now. However, again, long-term bearish, and that's the thing. You got to weigh when you're talking about bullish, bearish in this market of, are you talking short-term or long-term? Again, the short term right now is looking bullish. So I'm talking in that sense. If you guys have longer term plans, then we need to assess that based on longer term charts, the monthly, the weekly, stuff like that. So the thing I like about this push is ramping volume. However, it's not exceeding the volume that we had on the sell-off. That's my bigger problem, is on a grand scheme, volume is going down, price is going up. So to me, that looks like, okay, well, that's volume divergence. I don't necessarily like that. And especially if we jump over to Lexalgo just quickly, the MACD is separated strong and we got bullish flow on smart money, but we're heading into overbought territory. And we do have this area up here at the 447, which would coincide 447 with this upper node over here. So definitely can get a bullish break this week. Again, we got a lot of catalysts that we will talk in a second. That CPI report is going to be a massive, massive catalyst on Tuesday, so it's pretty much going to determine where we're going to go. These levels are valid till Tuesday, guys. Once we hit Tuesday, all bets are off. At that point, that's going to be the determining factor on the CPI report. We'll talk more about that in just a moment. However, I want to give you these levels that you can play off for the week. So we could be range bound because this is big move up, kind of consolidating this range. I wouldn't be surprised if we get a bouncy day. Now, NASDAQ, above a lot of these trend lines, above, so we're going to get rid of a lot of them just so we can clean up the chart here. So we're basically far from the bottom support there. We did have a lot of gaps here. Big, massive move on NASDAQ, 2.25% on the Friday. So again, taking the ranges for the week, we're very close to the upper range there. And then for the bottom support, we're a little farther away than the S&P, and we're actually farther away from the 50-day moving average for the NASDAQ. So that would be a more riskier play to play the bounce game there. That's 0.76%. So it's not unheard of for NASDAQ to run that range. However, I do not want to necessarily see it come straight back down towards this level. I kind of want to see more range bound, staying above the 373 level and really busting through that towards that 380 level, getting above this node right here. We have to note we have resistance around that 380 level. If you look here, I'm going to snap a line to it, and it's going to be a line of importance for us. That 380 14 number, we have where you failed to hold, rejected, and now we're coming back above it. That's going to be really, really important for me looking at this week. Does NASDAQ get above 380? If we get above 380, hey, the sky's the limit. And I believe that would bring us closer and closer to the all-time highs sitting around the 400. So again, once we get above that, we definitely could get. We do possibly have, again, in a longer term time frame, a head and shoulders, inverse head and shoulders forming here. So if we don't catch the bounce or break of 380, come back down, retest the 50, rotate higher, could be sending up that nice inverted head and shoulders on the chart. So we have to keep an eye on that just so we can make sure we're not keeping that out of range. Now, here's my problems with these ranges, guys. If we look at RSP again is sitting in the same range we had from the previous week. And actually, if we look at the weekly, we are not in a higher high, neither a lower low. So we're still inside the previous week's candle. However, the range is basically shrinking that where the RSP, which is the broader market, is going to basically be at. So if we take all these lines away right here, we can see on the daily, we're basically bouncing around support. We broke the downtrend, so that's a good thing. We broke the downtrend on RSP, but we are now going sideways. So we haven't gone above the 50, we haven't gone above the 50 weekly or the 200 weekly. So that just means to me that one of two things can happen. Either the S&P rally and NASDAQ rally is going to fail, or we're going to actually form that inverted head and shoulders on RSP, get a broader market rally, and then probably send the S&P and NASDAQ to possibly new all-time highs, Santa Claus rally coming to town. That is a possibility. It's not a guarantee, guys. Again, jumping over the Russell because this is important. The Russell is like basically your small caps, and it is absolutely in the toilet right now, guys. So as we can see here, we pretty much gave up not all, but a vast majority of the gains that we had from the previous week. So as you can see here, we kind of barely rejected off of the 50, and now we're basically heading lower. Just sold off, didn't even catch a good bounce on Friday. So this is telling me it's not a broader market rally, and we'll talk about that in the fear and greed index analysis when we do the debate. But again, I keep beating the bearish drum, but I'm also beating this bullish drum of the inverse head and shoulders forming right here. So you guys got to keep an eye on that. Either way, CPI is going to be the determining factor for this week. The volumes were a little light on the selling here, so it could just be profit taking. Again, setting up that inverse head and shoulders, really setting up a nice rally if it comes in. Again, the critical thing, I'm beating this dead horse at this point of CPI, CPI, and CPI. That's going to be the determining factor, and the reaction is going to be even more important of the determining factor for CPI. Now, what are the things that influence CPI? Well, let's take a look at the VIX. The VIX just absolutely got murdered. What I don't like about the VIX, if you're a bull, is that even with the sell-off, it just forming a leg, right? It's forming a leg, hasn't really come back, broken the 1288. We're down in the 14s. This is where you get those nice rip your face off sell-offs when VIX gets down into this level. So we have to keep a warning on that. The dollar looks like it's still got some life in it, barely holding on, actually broke below, closed above, broke below. So really the dollar's fighting to stay alive right now. It has a massive uptrend, went sideways, broke below the 50, but really is trying to regain it. So we're going to keep an eye on that. Probably give you a midweek update of that, or when we do a live stream, we'll talk about it. So I did say the dollar around this area was going to find resistance. We found resistance. Now we're below short-term support, but we do have and are above long-term support here. So we have to see what the dollar is going to do. Yields and everything are basically kind of indicating that we may get a mixed model response. Again, above the 50 on the 30, the 20, and the 10, looking like they want to catch a bounce, possibly forming that head and shoulders right here. or we're about to form a possible W on the way up. So again, we have to keep an eye on that. Looking at the shorter term debt, it is pushing up higher. So some of this narrative that the Fed is peddling, the market's not believing, the bond market specifically. Stock market can go be in its little insane little echo chamber, as I like to call it, as much as it wants. But looking at this, I go back to TLT. Banks got a small reprieve, and now they're basically back in the toilet again. So our bank's balance sheet's basically going to go back into the toilet again. As you can see here, this was the initial balance. Everyone thought this was the bottom, the dip get dipper, as they proverbially call it. And now we're struggling to hold short-term support for TLT, meaning more pain for banks. As we saw in some of the news articles, $131 billion paper loss for Bank of America, JP Morgan sitting on $40 billion. So not small numbers. Now, comparative to their sizes, that's pretty okay, but it is going to be very, very interesting and how it all rolls out. So with that, guys, let's jump over to the news. This is going to tell us what's going to happen this week. So let's see. Monday, no one cares. No one cares about Monday. Everyone cares about this number on CPI. Just quickly going over it because we're going to beat this into a bloody pulp when we talk about it on the debate section just shortly after. 4.1 expectation of flat CPI, guys. Month over month increasing flat, and month over month regular CPI going down and increase. So we're going to see core being stubborn. They haven't published the CPI number. I wonder why, as we're having the expectations not yet published for this. It's going to be interesting. I'm saying 3.8, 3.9 possibly if we just go to this real quick just to see how it's been trending for us. So let's take a look. We were 3.2, went to 3.7, stayed at 3.7. Remember, the 3.7 was a revision backwards. So again, we were at published, it was about 3.6, I believe, and then went to 3.7. So higher, 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 and higher. Do we get 3.8? Do we get 3.9? Do we get 4? Again, what are going to be some of the driving factors in that? As we saw, oil kind of just fell off a cliff. However, with oil, it is a lagging indicator. So you're still having these elevated prices. This is the CPI for October. So October was still in this elevated price area around September. So energy could have a minimal impact on that. But again, I don't think it actually will. So we have to keep an eye on that for us. So we have Goolsby speaking. Not really much, but we got PPI expected to come out the following day. Empire State Manufacturing Index is expected to be negative. PPI month over month for October expected to have similar to CPI. They don't have a published expectations for the regular or the core number, so we have to keep an eye on that. We will cover that probably on the Monday live stream if we're live streaming on Monday. Philly Fed Manufacturing Index expected to go even more negative. And as always, on Thursday, we get the initial jobless claims. And on Friday, we get building permits. So that's going to be another key point of data for us, guys, when we're talking about the housing market. And basically, is we going to start seeing deterioration in the housing market like everyone's been talking about, or are they all full of crap again? We'll talk about that probably in the next Weekend Deep Dive because that'll be on Friday. So we'll obviously cover it to keep you guys updated. But the best part is yet to come. Let's dive into the debate section. And as always, we're going to start off with CPI. So guys, Fatal sent me an article that I was like, this is just perfect. And my natural question to you, as always we do on CPI, what do you think the expectations are going to be?
Wait a minute, I have a question for you. Did you not know about that article that I sent you?
No, so that's the first time. So this is, it's a play the game for both of us. So I know the CPI expectations. That article you sent me is pretty funny. So remember, 4.1 last time for core, 3.7 last time for regular CPI. What is it going to come in at? What do you think the forecast is? Not what is going to come out. What do you think the forecast is going to be?
Well, hang on a minute. Do we have the forecast that they're predicting?
You have one of them. You have one of the forecast.
So you have the month over month, which is...
Oh, this is PPI.
Okay.
This is PPI. I'm hiding CPI, so you can't see it.
Oh, you're hiding CPI. Okay.
Yeah, come on. I want to be a game.
So what was the things before?
Previous core was 4.1 and regular was 3.7.
Right. Okay. Well, the trend right now for the normal is increasing. So I don't think we're going to get an increase. We might... we did see... I don't know about you, but... fuel, like gasoline, has kind of stagnated, actually fallen a little bit. So I'm gonna say, and that was for the month of October. I'm gonna say roughly the same, coming in roughly the same, maybe like a tick lower, but the 3.6, 3.7. And for core has been on a decline. So what was it, 4.1? So let's just say 3.9.
Well, I think I agree with you on the regular CPI.
Okay.
The reason I say that is because we don't have an official published number. However, core is expected to stay flat.
Okay.
So,
all right.
Which is funny, and the reason it's funny is your article. Powell says Fed is not confident, has done enough to bring inflation down November 9th, Thursday.
Yeah, that was on Thursday. That was when the market fell on Thursday because of that. But my whole thing with this is, why should I believe him? Why should I believe
Word
anything
salad?
he says?
Word salad?
Well, like
The dot plot doesn't mean anything. So
right.
therefore, the next dot plot doesn't mean anything. But we're not confident we've done enough.
Right. It's like we're past two-face. Right now we're on like sextuple face or something like that at this point. Because it's like
octface.
Yeah. Octuple, decatuple face, whatever.
Yep.
But it's like, why should I believe him? Right? Why should I believe him?
This is our face. This was your face when you read the article.
No, I was just like, why should I believe him?
Yeah.
Right? Why should I believe him? And the market believed him, but on Friday the market gained. So it's like, I don't know, right? I don't necessarily know. I have not read the article, but if you scroll up, we get to just take a look at the first 2 points, because that's pretty much like the summary all the way up. There it is. So Fed Chair Jerome Powell said he and his colleagues remain steadfast in getting policy in line with their 2% inflation goal, but we're not confident that we have achieved such stance. I mean, we haven't.
Literally in the last meeting, when asked, do you think policy is restrictive enough, said you literally said yes.
He said, that's the reason why we're stopping inflation, because we want to see that restriction on the economy. But now he's saying we haven't achieved.
Yeah, logic went out the window, guys. Logic.
Dude, logic went out the window at the inflation's transitory, where inflation is good.
Yes.
Logic went out the window there.
So, I don't know if you've seen this. I did cover it in the beginning part of the video. Have you seen the inversion of the yield curve? Because I swear, if you say one more thing about it, I'm going to throw something at you.
What do you mean?
Sir, you were right about this yield curve. It's starting to go back up.
That's my point. That's my point.
That's not a good thing. That means end times.
So I just have a question. How is it inverting? How is it inverting back up? Because remember, the reason why it was inverting,
the same way it inverted before.
Well, so the reason why it was uninverting, it was because I believe that the 2-year was catching up to that of the 10-year.
Well,
or sorry, the other way around. The 10-year was catching up to the 2-year.
Correct.
Right.
So both of them got a cut, but the 2-year rebounded harder than the 10-year. So the 10-year had a cut. It really hasn't had a good rebound versus the 2 that had its cut and basically is rebounding right back. So it dipped below when Powell came out. It dipped below 5% and basically wrote in it now when Powell basically the bond auction plus everything else, aka the bond market doesn't believe the Fed in any way, shape, or form. We're indicating that by yields. We're indicating that by the yield curve basically saying, okay, we're going to do loop-de-loops now. And I did say it officially hasn't broken the localized high. It double-topped it. Right. But that's not, when I cover this a lot on the channel, you really want it to say isolated to this level going sideways, even especially after we pass the anniversary, which is the yellow line, of the great financial crisis inversion. So are we going to get a massive up-down swing of volatility? That is possible, but this yield curve has basically been the conglomeration of every yield curve inversion in history mashed in together. And then we have a Fed incarnation that literally said, dot plot out the window, where I'm just like, am I really that surprised that the yield curve is doing this? But I'm absolutely not.
I just have 2 questions. So the yield curve is it's not uninverting, it's inverting back.
It's inverting back even worse.
Right. But with the 2-year going back up.
Yes.
And the 10-year not going back up as much.
Correct.
Okay, gotcha.
So it's
And my
basically the same way inverted before, where the 2 years skyrocketed. But here's the thing: that doesn't necessarily mean, though, if the 10 goes up, the 2 doesn't continue to go up with it.
Right. Right. That's what we were. That's why we were seeing that de-inversion, because the 10-year was increasing at a much higher rate than that of the 2-year.
Yep.
I get that. But my second question is, and this is just me being very, very ignorant and not knowing anything about technical analysis, is there a way that you could get like a 200 SMA on the yield curve?
No, because it's a percentage base. So
Okay.
you need closing candles. So this is basically taking Fed data, which is the federal funds rate database, and doing this analysis. But it would be interesting to see. But I think that SMA would look very wonky. But yeah.
Well, I was curious, like, would we be under the 200 SMA right now?
No,
right?
you
That's
would.
kind of just.
Well, you can kind of. Well, not really, because your average price would probably be down in still like standard negative prices, which would be uninverted, because it's not historically over time. You don't spend a lot of time above zero. Right. So you traditionally in the negatives, because I did it 2 minus 10 versus 10 minus 2. That's why positive inversion versus traditionally on every chart you see as a negative inversion is just easier for me to see and kind of comprehend. So that's why we have that. But to me, it's interesting when we go back to this real quick. Core staying flat, along with his comments, we haven't done enough. No
at least
crap.
Not confident. Or at least not confident.
Yeah,
right?
Because again, if we go back to core CPI, right? Let's just open core CPI and do a simple analysis of this. This is where you were before. Look where you are now. You're nowhere near 2%.
Right. But again, it's not so much that he's saying we're not confident, is because if the last FOMC meeting he said the same thing, I would be like, all right, he's at least being consistent with it. But he just did, two.
He did loop-de-loops around his own statement.
Yeah, he just did like what is that, 720, or is that, no, that's two 360s. 360 plus 180, whatever that is. He like five something. He just did that when it came to this, right? That's the part that bothers me the most, because in the FOMC meeting, I'm still of the opinion that he gave, on the FOMC meeting, he gave the markets the green light to shoot it up, right?
Yep.
But now he's just like, nope, dialing it back. It's just like, but you just said, it's just.
But markets aren't. If you look at RSP and Russell, I covered this in the key levels, but you weren't here for that part. But the RSP selling off, IWM during the week, cratering. So again, it's this thing of like, I did this hot heat map analysis of like 3 months. If you look at it, like if the market, what do you notice? All the big caps. All the big caps.
I know. Even on the week, right? If you bring that up on the week, it's the exact same thing.
Yeah.
The tech companies are the ones bringing it up. Like the bottom right part of the entire heat map here, it's all in the red. Not all, but majority. But it's mainly the big tech companies that are bringing this thing up, which, I mean, we've seen this before.
Oh, yeah.
Right? We've seen this before.
And we know how it ends every single time.
Well, my whole thing is that I'm still holding to the fact that by the end of the year, we're going to get an S&P 500 near 52-week highs, or if not higher than 52-week highs. Not all-time highs, but just 52-week highs.
Then traditionally that aligns with the historical context of November and December being the most bullish months. Right. Case in point, if we pull up a monthly chart right here, as you can see, it's like November happens, blink, right to the moon. Now, we're only halfway through November, or not even halfway, and you got CPI, which is going to be a pretty big pivotal role, because the Fed may have to eat turd on Tuesday, which would be very, very enjoyable for me to watch. But again, the monthly chart looks like it wants to go higher. We basically said that. The weekly, the monthly, everything. So is it going to continue? We got to see. To me, I definitely could see the Santa Claus rally. That's not, I said it openly, it's short-term bullish. However, come January, come Fed meeting in December, that could all change. We could definitely get a rug pull moment.
Sure, but I highly doubt it because, I mean, I believe the next FOMC is on the 13th of December, and I think CPI is roughly at this, is maybe like a day before for December, if I'm not mistaken.
Let's pull it up.
Yeah.
So
let's pull
around the 13th, I bet, or
yeah.
So let's pull up that range.
Yeah, pull up that range, and I believe that, yeah, see, Fed interest rate decision. So we don't have...
On Wednesday the 13th, and then CPI will be probably the 12th.
Right, the 11th or the 12th. So, yeah, that's just what we're looking for that one. But here's the thing. If this CPI, right, comes in slightly lower, the markets will rally. And if, for example, PCE also comes in lower as well at the end of the month, well, most likely the Fed will pause again. Yeah. Right, the Fed will pause again. And I don't know if you have that up, but do we have the expectations for the December's interest rate hikes for the CME tool?
Oh yeah,
or
we
no?
can pull it up.
All right, let's pull that up real quick.
So, but the thing is, the CME tool, it's a popularity contest at this point.
I know. I just want to know.
Expecting a pause. But it's interesting. It's a little interesting because if you actually look, there's still 10% expecting a hike in December. So they haven't necessarily, to me, I view it as the December timeframe. They're no longer talking about cuts, right? There's not for a short period of time, there was a 5% possibility of cuts in December. And if we let's take a look at June, where they were basically saying cuts in June. They're still saying that, as you can see here, the expectation is 41% cuts in June. That narrative has not been beaten out of them. And I think they're hyper-focusing on the cut piece now because the Fed pause, you had the euphoric jump, and now the narrative is shifting to when is the Fed going to cut? When is the Fed going to cut? And that's going to be bumpy, because the Fed only cuts when everything is breaking, when everything is broken, burning, on fire, singed to a crisp. So again, I don't know who said it. You told me this, that you better not hope for the Fed to cut rates because you don't understand what that actually means. It's some economist or someone said that.
I believe that was one of the big banks. I believe it was the guy from Goldman Sachs or something. Somebody said you better hope that the Fed doesn't cut, because if the Fed does cut, that means something is terribly wrong.
Yeah,
it's actually healthy. If they continue to raise it or keep it the same, that means that everything's still okay. But if they continue to cut, oh boy, something just went terribly wrong. But the last thing I want to take a look at is when it comes to the whole fear and greed index, because we had a massive rally.
We went nowhere.
Did we really go nowhere? It's still at 42?
It was 41, 42 last time we covered it, and I actually haven't looked at it, so I was like, hey, it was 41 last week. What is it going to be this week? We literally went nowhere.
I thought we were going to be up towards neutral.
75, especially with the rally you
neutral.
Had.
Yep. No. I would say around neutral.
So,
because a 1.5% rally on the week isn't major. So I was thinking more along the lines of neutral, but market volatility is definitely neutral. So
one of the things, speaking of volatility, I did show this before, but VIX on the week went nowhere. AKA, people are kind of buying insurance. Why are you buying insurance in the most bullish time of the year? It's because you don't trust these what, because they literally pull everything out of their butt now, and they have lost all credibility, in my opinion.
Oh, absolutely.
At this point, after that meeting, the Fed's credibility went out the window. That's your worst case scenario. It's kind of the thing.
The Fed's credibility went out the window. Again, interest rates. Inflation's transitory.
Yeah, they still had a shred.
Let me remind everybody.
They had a shred of credibility. I think now the market's just nah. Nah.
Let me remind everybody. That whole inflation's transitory. Guys, we're heading into 2024. That was 2021. That was 3 years ago, almost 3 years ago. That wasn't that long. That was not that long. And it feels like an eternity ago.
Oh, yeah.
Yeah. So, just FYI. FYI. But
I'm
actually not surprised.
Recapping really quick before we conclude. the stock strength and breadth stayed down here in fear and extreme fear because the broader market didn't rally. You need that broader market rally to really get up into that 75s neutral. Well, neutral, you can still get the big six to get you to neutral. I'm a little surprised that we're not here, like you said, around 50. We're in the upper extreme of fear, but again, we're not put call ratio just stagnant since all the way back in August. So again, people haven't really decided where they want to go. Junk bond demand, well, this is always going to stay greedy as long as the 2 month, the 6 month, the 2 year, the 1 year are paying you these real rates. As long as that's going to happen, I wouldn't expect junk bond demand to even move an inch. Safe haven demand, again, treasuries. They're honestly, treasuries have become really exciting in the sense of you want to deal with all this craziness or you want to be basically paid where you're at now. So the pendulum is swinging back towards treasuries, buying them, which is also helping inject liquidity because people are basically sick and tired of basically, if you look at S&P, these large swings. They're getting sick and tired of this. They are traditionally known for this type of market. Like market only goes up.
Yeah, and to make matters worse, the S&P 500 is only gaining because of the tech sector. That's it. If you take a look at the energy sector, falling. If you take a look at any other, the REIT sector, falling. Everything is falling. Yeah, it's the tech sector and a few companies here and there and the other sectors that are bringing it up. But it's mainly tech. So that's just fairly surprising to see. But I think that will pretty much do it for this video, everybody. Make sure to like, subscribe, comment. It really does help with the algorithm on YouTube as well as Rumble. And it's going to be an interesting week next week. We also want to at least try to live stream a few days, especially for Home Depot. That's Tuesday. We got Target and I believe one other one on Lowe's? Wednesday. No, not Lowe's. Lowe's is the following week. Yeah, Home Depot and Lowe's do it like 2 weeks apart or like a week apart. On Wednesday, I believe we got Target and another one. And on Thursday, we got Walmart and Alibaba. So those ones we might want to take a look at on the live stream. So yeah, just be on the lookout for that one. And yeah, guys, with that said, peace out, and we'll see you all next time.